We have been discussing on how people form expectations, uh, and we have seen some evidences that people do not use the Bayesian updating to form the expectations. So in continuation of that topic, we are in a new anomaly. I mean, our new topic, new anomaly we are discussing on. So such anomaly is share repurchases. So you probably are familiar with the share repurchases event announced by the company. So companies periodically announce share repurchases, share issuance very frequently, not very often in our country, but very often in the developed country. So when company announces share repurchases, it is a public disclosure. So what happens usually when share repurchase event is announced by the company, market observes that that company's share go up, and if the company announces to issue a new share, that company share prices are likely to go down. So let's stick to the share repurchases topic, and we will see that what are the issues with it. So what are the reasons that why when share repurchases are announced by the company, what is the reason that take the share prices to up? Okay. So there has been empirical evidence which have found that company CEO and company CFO are more likely to announce share repurchases when they see that their shares are undervalued. So people know that as CEOs and CFOs have announced that they will make the share repurchase, probably the stock is undervalued. That's why they have announced the repurchases. So that's why they demand that the stocks more, and their increased demand take the price higher. And the idea is that obviously it is not a bad idea that with the announcement decision from the company CEOs and CFOs, investors get a signal that probably the share is undervalued. So what's wrong with it? The wrong with it is that we have learned from the market efficiency that when something good is coming from the company or when something bad is coming from the company through the public disclosure, the response of the market price should be immediate. So it is good that investors have realized that the stock is underpriced. So if the company announces the event, say for example on 6th October today, so the price should immediately up by the 6th October or mostly 7th October by the percentages for which the share price is undervalued. So there will be a positive adjustment for the announcement of share repurchases. If it happens, then we can prove that there is a semi-strong form of efficiency in the market. So you can recall the semi-strong form of market efficiency definition, where market prices reflect the information of all available public disclosure. Okay. So this paper, Ekenberry et al. 1995 examined how market prices respond to the public disclosure of share repurchases. So he observed that on the announcement, upon the announcement of the share repurchases, the stock price increases by 3.5% on average when repurchases are announced. So for example, 6th October repurchases has been announced. So you should observe that on an average, there is increase of 3.54% increase of share price of that company's share price. Okay. So if you believe in market efficiency, that market is efficient in semi-strong form, do you expect that this increase will continue, or this will be in a flat level? I mean, the prices will be in a flat level. You can recall from the efficiency test by the pharma friends who proved that there will be a ladder kind of adjustment. So it's not a like upward sloping adjustment for the good news for 3 years, 2 years, or 6 months, or 9 months. Okay, so what do you expect that if the market is semi-strong form efficient, do you expect that the price of the company's share will go up again after the announcement date? I mean, say after 2 days or after 3 days? What do you expect? Or you expect only there will be a this kind of percentage up on the announcement date? What do you expect if the market is semi-strong form of efficient? Share your responses. I'm waiting for. Yeah.
Sir, yeah, if the market is semi-strongly efficient, the price will go like a jump on the prices, not like ladder.
Right.
Yes, sir.
I mean, let me take a. Okay. So what I'm meaning, say for example, prices here. You see my red color? Okay. So
No,
on this date, you see my red color? I mean my ink?
Yes, sir.
no, sir.
You should see it. Okay. So say for example, it is the announcement date. I mean the announcement for share repurchases. So on the announcement date, there will be a jump of the price. So this percentage has been measured on an average of how much percentage? 3.54%. So after this, there will be day 1, there will be day 2, day 3. I mean the after announcement date. So if the market is semi-strong form of efficient, the price movement should be like this. I mean the straight line. Okay, I mean horizontal line, assuming that there is no more new information during this period. Have we got it?
Yes, sir.
Yeah, okay, we are expecting like this. Okay, but Ikenberry has found what he has found that prices continue to rise 4 years. You see how big the period is. 4 years after the announcement. So do you expect that if it happens, that price continue to rise 4 years after the announcement of share repurchases? Do you think that market is obeying the semi-strong form of efficiency, or market
No,
does
sir.
not obey this, right?
The market does not obey the semi-strong efficient.
Right. So you see here what we are observing. Okay. So you see what is happening. Okay.
Yes, sir.
So what is happening? Which one is the announcement date? You see the 0. You
Yes,
see the
sir.
0 here. Okay. So 0 is the announcement date for what? Share repurchases, right? Okay. So we expect that obviously there should be an upward adjustment. So there should be upward adjustment. But we have seen that, I mean, the authors have observed that these are different forms of return measurement. You see 3 different lines. So 3 different lines are, there are actually 4 different lines. So 4 different lines are 4 different types of return measurement. but we see that returns are, I mean, the higher positive return are coming from further positive movement of the price. So you see, this positive movement of the price continues for how many? Approximately here, around 45 months. So 45 months is around 3.5 years, or more than this, right? So you see, so that has been happening. So we have seen that this is a market anomaly. It is not expected, right? Okay. Now the question is, we look for the reason that why does it happen? Okay. Why should it happen? Uh, the idea is that this kind of anomalies can be summarized in a way. Okay, let me ask you. Let me ask from you: is it an underreaction or overreaction if the return continues to move upward?
It is an underreaction.
Underreaction of the investors. So it means that investors didn't act properly on the announcement date. That's why the price continues to move up. So the more and more returns are accumulating. Okay. However, this adjustment should happen on the announcement date. Okay. So we like to see what are the reasons. Okay. So can you recall the R? We talked about the representativeness. So representativeness causes overreaction, and conservatism causes underreaction. Okay. So these are some two behavioral issues, but these two have two different consequences. So representativeness and conservatism causes overreaction and underreaction in a stock prices respectively. But we have seen that they are just the opposite of each other. So you can recall one interesting paper I shared with you, the Grin and Tversky paper, 1992, where they have introduced the two effects, strength and weight. So strength and weight causes this kind of anomalies. So we already have seen some anomalies, but we can explain the anomalies in terms of the strength and weight. So if some information is very extreme, that information is likely to cause investor to act in aggressive way or to be overreactive. So for example, a company has a company has performed very well in past 5 years. So you see that a company which has performed very well, very outperforming in the last 5 years, is a very extreme information. So that information, what I just have shared, has more strength, So if investors get such information, it is more likely that they will overreact to the share price of the company. However, we have seen that because of the mean reversion of earnings tendency or regression to the mean, which is the natural phenomena, this kind of extreme is not likely to continue. So what we see that this kind of information, what I just have shared, this company has performed very strongly in the past 5 years. It might have more strength, but it would have very little, it would have less weight. Less weight in a sense that because of the mean reversion of earnings, a company which has very strong performance in the past 5 years, it is not likely that that company might have again will be continue to perform very strongly in the next 5 years because of the mean reversion of earnings. So the predictive ability of the information, what I just have shared, the very strong performance in the past 5 years does not have a very good predictive ability for the next 5 years performance. So this information has more strength, less weight. In that case, you should expect what kind of action, overreaction, what kind of reaction, overreaction. And I just shared some of the anomalies. So let me link this anomalies. Can you recall the long run reversal? Can you recall the long run reversal? So what we have seen? In the long run reversal, we have seen that the companies which performed very strongly in the past 5 years do not perform strongly, rather perform poorly in the next 5 years. That's why, because investors overreacted to the information about the past 5 years performance, what investors do, investors take the price upward because they are overreacted to the past performance information. And that's why if you buy the past losers and sell the past winners, you will have a abnormal return. Can you recall that strategy? Yes, no?
Yes, sir.
Okay. So that information, strong performance in last 5 years has a what? High strength. But in terms of weight, it has low weight. Okay. So why investors causes such, I mean, if you try to make money out of the investors' overreactive behavior, what are the reasons? Because general investors, because of the representativeness, what they do, they extrapolate the past information heavily to predict what is going to happen. That causes the overpricing, and that is the reason that which give the abnormal return from the long run reversal strategy. Okay. In the opposite case, some information might have less strength but more weight. Less strength, more weight. So what kind of information can be such that? So the information is likely to be not very extreme. It's not very, I mean, very attractive, or it's not likely that it will influence the investors very strongly. So in that case, it is likely that investors will underreact to such information. So we just have seen the share repurchases. So share repurchases are in the category of underreaction. You see the repurchases, we already talked about the momentum, post-earnings announcement, drift, dividend policy changes. In all of the cases, what we have seen the evidence of underreaction. So for example, in the dividend policy changes, we have seen that the company which have decided to initiate the dividend, they continue to experience the rise of the stock, you see, for next 3 years. And the company which decided to stop the payment of the dividend because of the sudden changes in their cash balances or whatever the reason, and you see that their share prices continue to go down for the next 3 years. So this is an evidence of what? Underreaction of the investors. So investors underreact to those information because those events are singular. Those events do not have the extreme kind of signal. That's why they, but they have more weight in a sense that they provide very accurate signal about fundamentals. However, because investors look at the information in terms of how much strength the information has, and they see that this information does not have enough strength, that's why they underreact to such information, and that causes underpricing, and that causes that results in return from the momentum strategy, results in return from the share repurchases strategy. So what kind of a strategy you can take? You see that as you have learned today, that when the company announces share repurchases, the positive movement of the price will continue for next 4 years, right? So you can make a strategy to purchase the stocks after the announcement. Will it lead to profit to you? What do you think?
Yes, sir. After the
Yeah,
announcement, I should buy the
right. So you are getting
prospective share.
some,
Yes, sir.
yeah, right. So you are getting some predictive information from this kind of behavior of the investors, and that is affecting the movement of the share prices, right? Okay. So all the anomalies what we have seen with regard to the how people form expectations can be classified in terms of overreaction and in terms of underreaction. And we have learned that the information which has more strength, for those information, investors are likely to overreact, and the information which has more weight and less strength, and we have learned that this information are likely to cause investor underreact to such information. Okay. So this is one of the most famous theories in the behavioral asset pricing, proposed by the Barbaris, Schleifer, and Vishny in 1998. So what they did, and they combined the conservatism and representativeness with the, I would say, the strength and the weight factor given by the these authors, Grin and Tversky, to explain that why the investors believe in such a way which is not rational, and which gives some abnormal return to the investors who to the arbitragers who can make money. So they propose two model, but they have provided some general assumption like that there is a representative agent. So think of investor, general investor, general noise trader who does not act rationally. So think of such an investor, and they provided the argument that earnings are a random walk. You are familiar with this concept, the random walk concept. So a stock price is a random walk. You cannot predict it. So earnings, they also provided the argument that the earnings are also random walk. So you cannot predict the next month or next quarter earnings from the current quarter earnings. Okay. So they might move in upper positive direction, they might move in negative direction. However, investors does not believe in the fact that in earnings are a random walk. Okay. So what investors actually believe? So investors believe are false because they are falsified by two situations. So what two situations they actually mentioned? They mentioned that investors beliefs are influenced by two regime. So one regime is mean reverting regime, another regime is trending regime. So what does this actually mean? So an investor, say for example, investor A. So if the investor A believes if investor A is in the mean reverting regime, what investor A does, or what will be the expected behavior of the investor A? The thing is such that, say for example, a company has performed very strongly in the Q1, Q2, Q3, and Q4 is forthcoming. Which quarter is forthcoming? Q4 is forthcoming. So what investor has already experienced? Investor has experienced that Q1, Q2, Q3, all are outstandingly good. Okay. So as investors are from the mean reverting regime, investors tend to believe that the next quarter earnings is likely to be, underperforming, or likely to be lower. So what kind of pricing they will make? They will underreact to the they will underreact because they are in the mean reverting regime. So how they will underreact? The thing is such that they will have a they will underestimate the forthcoming earnings, right? So what they will do? They will underestimate the forthcoming earnings. So when they will underestimate the forthcoming earnings, what is expected to happen? If the company continues to perform well, investors will face some positive earnings surprise. Investors will face some positive earnings surprise. So when the investors are mostly from the mean reverting regime, and in that case, they are expected to exhibit underreaction, and you are expected to make some return from the momentum strategy. So momentum strategy comes from which reason? Because the investors underreact. Investors underreact, and one particular fact, this B, S, and V propose that because that investor is from this group who are from mean reverting regime. Okay, and another group of investor who are from the trending regime, So what they believe that say for example, company has done extremely well in the quarter one, company has done extremely well in the company quarter two, and also in the quarter three. They'll believe that quarter four will be beyond the performance of the company which are reported in the past 3 quarters, quarter one, quarter two, quarter three. In that case, what do you expect? You expect that there will be a overreaction of the investors. So if investors are overreacting, what is expected to happen? You will see that investors have taken the share price to a very high level. And what kind of a strategy will give you the money in that case? If the investors are mostly from the trending regime, what do you think? What kind of a strategy will give you the money?
So selling the share would be good for investor.
Yeah, kind of contrarian strategy. So you have to take the decisions just the opposite of this group of investors. Okay, so you can recall the reversal, as I was saying, the selling the winners and buying the losers. Okay, so if you think just the opposite case, a company is performing very poorly in the quarter one, quarter two, quarter three. So if investor is a group from trending regime, what do you expect? What will be their expectation for the company's performance in the quarter four? What do you think? More poor?
No, sir, more oil. If it is in the trending regime.
Yeah, in the trending regime, the quarter one, quarter two, quarter three, the company's performance are not good. So if the investors are from trending regime, what will be their expectations for the quarter four?
The share price will, the company will perform more worse than quarter one, two, three.
Yeah, in that case, they will depress the price.
Yes, sir, they will depress.
They will depress the price of which companies? The companies which performed poorly. Okay.
Yes, sir.
So in that case, the reversal strategy is likely to give you the money. Okay.
Yes, sir. Yes.
So in this way, you see that you can link up the momentum reversal, and you can recall that you can make money from the momentum in the short run, and you can make money from the reversal strategy in the long run. Okay. And this is just the picture from the momentum strategy. You can recall the Jagadish treatment paper we shared earlier. So momentum will give you abnormal return in the short-term period. So the the periods are in the horizontal axis and cumulative returns are in the vertical axis. So it will not be for a very longer run. It will be for a shorter run. It will continue. Okay. So maximum, it is expected that maximum for 12 months or maximum for 1 year, you can expect 9 to 12 or 6 to 12 month holding period. You can expect a positive return from the momentum strategy. So this is all about what we had to say about how people or how investors form expectation, and these are some essential readings of that chapter. Okay, so I'm closing this chapter. Are we making a recording? Yeah, we are making a recording.